Hey there. I hope you're having a great day. I'm Jim Munchback, CEO at Bayrock Financial, and I wanted to kind of do a bit of an update on U.S. Treasury yields. A lot is going on in the markets, in the bond market in particular. And so I wanted to spend a few minutes and just kind of cover a couple of things, including an investment idea that I think I want to share with a few folks who have been asking me questions about about how to invest right now with yields going higher and higher. And so that's one of the things that has prompted lots of conversations, lots of meetings. And so if you're thinking about what to do with your cash in your 401k or your IRA or your trust account or whatever, that is the big question of the day. Do you put it in a money market account? It's paying 5.25% interest, which isn't a bad idea at all. But I want to share a couple of things that may help you make an informed decision about your investments. So we'll spend a few minutes today just talking about what's going on in the bond market. We'll take a quick look at the yield curve. I'll show you help you read what's the yield curve and how it works and why it matters and how it will affect your investments. And also, let's see, we've got interest rates. Our interest rates, inflation, and economic growth are really the keys to the stock market and how the stock markets will behave in the future, and the bond market as well. So those are all things that are affecting your account and mine. The investments are going up and down, the value of those holdings. And so that's one of the things I want to talk about is higher highs and lower lows. If you're a client of mine, if I'm helping you manage investments, that's one of the things I've been saying for many, many years. We're having higher highs and lower lows in just about every asset class. And now we're seeing higher highs and lower lows in the asset class called bonds, and that's because of interest rates, inflation, and so I just want to highlight a couple of things related to the fact that we're having higher highs, that's higher yields, higher and higher, and that is in an inverse relationship to the value of a bond. So if the yields go higher, the bond values go lower, and that's what I want to show you next. Is I'm just going to take you over to the let's take a look at one of the investments that I'm looking at. And in fact, I've been investing in this for some time. It's called TLT. TLT is, let me get rid of this. There we go. Sorry about that. This is TLT. This is, it's down today again. And so if we take a look at this chart, this is a one-day chart. If we look at a 6-month chart, you will see the epic unfolding of the bond market because of rising yields. And so this is just a chart of the TLT. It's like a 20-year bond ETF, exchange traded fund. And so it's one of the vehicles I like to invest in, have been investing in from the beginning of my career as an investment manager. This is a long-term large holding, very liquid, very low expenses. So if we just take a look at this, you can see there on the right, the expense ratio, see that it's 0.15. So if you look at those money market funds that are paying 5%, 5.25%, you'll see that they're mutual funds. They're not exchange traded funds, and that's okay if you're a professional manager of money, though, or if you're a do-it-yourself or a day trader, or if you're more active trading, then an ETF, an exchange-traded fund, is a more useful vehicle for a couple of reasons that I'm going to show you. So the TLT, currently the 30-day SEC yield is right at 4.65%. And basically that's pretty close to what the money markets are yielding right now, and a little bit lower expense ratio. But that's not compelling. That's not a compelling reason for you to consider investing in TLT. And this is certainly not investment advice. This is just a couple of ideas what I'm doing. If you're a client of mine, you're probably wondering what we're doing in your portfolio. And one of the things we're doing, I'm about to just explain that this is an ETF, exchange traded fund. And one of the things we like about an exchange traded fund is this options chain right here. So if we take a look, if you are a client of mine, I've probably been preaching to you from the very beginning that options are a good way to manage risk. It gives us additional tools in our toolbox to manage the risk in your portfolio. So if we just go out to a 30-day contract of TLT and we look at a call option, that would be give us the ability to hedge losses. This is what I've been doing in my account and clients' accounts. So if we look at, let's say, so TLT is trading at $83 right now. I would not recommend selling a call on TLT today. Yesterday, I sold some calls on TLT. And when TLT goes up, look again. When you look again at that chart, you'll see that it's been pretty volatile. I can't expand that screen, but if you look at the lower right side of the screen, you'll see some green candles, and those candles are basically TLT moving. A lot of volatility is what I'm trying to say. We've had lower lows in TLT, but we've had some volatility. So if we look at an options chain, on the day, one of those days when TLT is up, we would want to sell a call. So if we did that today, which I would not do today, we would have a call option. Let's see, I'm in the wrong account. Sorry about that. I wasn't even going to show you my accounts, but I wanted to show you this option strategy. So if I were to sell to open, and I would want to select, again, 30 days out, if I look at what are the options, the call options, we're going to sell an option, which is going to give us the ability to protect our investment in TLT to some extent. So if I sold a call, if I bought 1,000 shares of TLT and sold, I want to sell to open, and you can do this in your account if you have options, but this is just basically an illustration of what we would get if we sold this call option. So again, if you have $1 million account, or even $100,000 account, you would certainly not have 1,000 shares of TLT. But if you did have 1,000 shares of TLT, we would sell this call. Again, not today. We would do it on a day when TLT is high, but 30 days out, 40 days out gives us a pretty good high probability of success, which I'll go into in future videos on how to trade options if you're wanting to learn more about trading options. But I just wanted to show you this basic strategy for ways to take advantage of this opportunity with higher highs in yields and lower lows in bond values. This is a situation that I'll share in a minute why I think it's very likely to change in the future, relatively short term, but maybe not, maybe a year and a half. And if that's the case, this strategy gives us the ability to earn money by selling calls against our TLT, in addition to that pretty nice dividend yield that we get already from TLT. Because again, when bond yields are high, the value of the stock, the bond, the value, the principal of that investment goes down. But the more it goes down, the higher the yield, the more you're getting in a dividend. And so I think TLT is positioned for in the next year or two, could be in the next 6 months, to have a stock-like rebound. And I'll show you the chart again in a minute. But I just wanted you to see you get about $2,000, $1,900 if we sold 10 calls with an $84 strike with 30 days out, and we would just let that call sit there and erode, or decay is the term in an option I sell options. I don't buy options. That's a higher probability of success. If I manage your money or my money, I tend to not ever, I don't generally ever buy an option. I am a seller of options because I always want the time decay to be working to my advantage and yours too, if you're a client. So that's the strategy. I'm not going to make that. I'm going to go back to this TLT. This is just on Charles Schwab. I'm just looking at this. I'm looking at this holding, and now I'm going to go back and just look at the chart one more time, just to show you that again. You can see TLT has been very volatile, just like all fixed income, all bonds. Anything related to a bond that's influenced by yields has been pretty volatile lately. And over the last, since the Fed has started raising interest rates, we've seen a tremendous increase in yields, and that means a significant reduction in the value, the principal value of your bonds in any bond holding. And that again is something that has been historic since, I think, 1781. I can't remember the year for sure, but last year rather, was the worst year, and this year is turning out to be just as bad. So the chances of having 3 years in a row of epic losses in bonds is, well, it's never happened. And so it's another reason why, again, when I look at higher highs and lower lows, see if we can get that to pop up on the screen. Higher highs and lower lows is something that is been happening in lots of asset classes. We're seeing, because of the Fed, and I'll show you again a couple of things that I think are relevant, but we've seen higher highs and lower lows because of the ways that our government and the Fed has been manipulating money in the money market and printing money like crazy. So if you think back to the time of COVID, you may remember that oil was trading at like negative $40 a barrel. That would be what I would consider a lower low. And then it just turned around and went to almost a higher high, $90 a barrel. I think it's trading at $82 a barrel today. My point is simply this: if you're an investor, if you understand risk and return and reward, you know that you can't make money as an investor if you don't take some risk. And so let me jump into a couple of things just to share. I wanted to show you the yield curve. The yield curve it's inverted. This is an inverted yield curve, very odd looking yield curve. And the way this works is, so if you look at the top left, that's the interest. So that's a chart. The top is the interest rate and the lower is the duration or the time. So can you imagine getting paid government securities paying 5.5% on a 1 year investment? And then you look at the 20-year, you can see the 20-year yield is pretty high. It's higher than the 30-year, it's higher than the 10-year, but the 10-year is again almost 5%. It's bumped on to hit up nearly 5% for the 10-year yield. The 10-year yield is the one that everybody looks at. It is very critical. So one more thing I want to show you is the fear and greed. If I can hide the reader here. This is something I look at every once in a while. It kind of tells you what the current feeling is in the market with respect to fear and greed. So we look at the VIX. I look at the VIX. That's a measure of volatility, and you can see that it's up 10% right now as we speak. And that's something that is causing, there's so many things in the market that are causing uncertainty, including Israel's terrible attacks by Hamas, the terrorist attacks in Israel, and our preparation in the United States. That's creating geopolitical tensions that are certainly putting weight on the markets and partly causing this kind of volatility in the markets. That's one thing. I just heard that we have elected a speaker finally, so hopefully that will eliminate a little bit of uncertainty in the market by having a speaker in the House. We haven't had a speaker for a couple weeks, which is crazy. So now I want to just show you one more thing that really impacts yields, and that is debt, the national debt. So just take a look at this. This is the U.S. national debt. It is an epic number that has increased at a rapid pace. And in my opinion, this is the single most important reason why the U.S. Treasury yields are so high. Because the United States has spent so much money, we've printed so much money, we have so much debt that we will very likely never pay it back. Look how much debt we have per citizen. That's per citizen. Look at how much debt we have per taxpayer. That's you and me. I paid my taxes last week. As a business owner, I had to pay some more. I didn't put enough in for estimates. So what about you? This is the official U.S. federal budget deficit for 1 year. It's insane. It is just insane. So I could go, this is something I would encourage you to look at, the U.S. debt clock. You can see tons of information about the U.S. debt just by looking at the U.S. debt clock, and it is unbelievable. It is one of the reasons why U.S. Treasury yields are high. So let me go back to, I'm going to talk a minute about the Fed effect. So the Fed effect is, let me get this out of here for a minute. The Fed has done a lot to influence the stock market over the last few years, since 2008, since well before 2008. But at any rate, the Fed is someone who can influence what's happening right now. And so one of the reasons that I'm rather optimistic about investing in bonds and TLT in particular is because as interest rates and yields go so high, now the Fed really only influences the short end of the yield curve. So we were looking at the 1 year, the 2 year. The Fed sets the rates for that, but the bond market is this unknown entity. The bond market sets the yield on the long end of the curve. And so that's what's happening right now. The market is determining that the risk for investing in bonds is higher. Why is that? It's because we have an unbelievable amount of debt as a country, and that's why the bond market is saying we're going to have to pay more in interest if we want folks to invest in our bonds. That's a very simple explanation, but it's when you look at that national debt, I think it's self-evident that that's partly what's happening right now. So that's the Fed effect. Inflation is what they're fighting. The Fed is fighting inflation by raising interest rates. I think we've come to nearly the end of the Fed raising interest rates. We'll see, but we're certainly getting closer. We're closer than we were last year, and something always gets broken when the Fed steps in and does what the Fed has been doing. And they're fighting inflation. Good for them. They're active. They're fighting inflation, but they've created what I would consider this yield spike is part of the market reacting to a rapid increase in rates. And so that's something that is causing these yields to go up, which is what's causing bond values to go down and the stock market to be very volatile. And again, that's the bond market, that entity of unknown players in the market who set the rates for the long end of the yield curve. What happens typically is some kind of liquidity event. We saw that earlier this year with Silicon Valley Bank. Banks don't have they just don't have the liquidity to take care of business, to make loans, to provide money to their the holders of their debt. It's liquidity events like happened in 2008 in the great financial crisis. When that happens, whenever it comes close to happening, the Fed will jump in and they will have to do something. And when they do, we'll see yields drop and bond values go up. That is my, not my bet, that's my expectation from my experience in doing this for a while. And so I just wanted to kind of point out that the Fed interventions, the Fed will do something at some point differently than what they're doing now. And when that happens, we're going to see some changes in what's happening in your investments. So now I want to just talk quickly about what do you do about it. And this is something that I think you want to maybe consider. You can go to noriskinvesting.com. No is K-N-O-W. Thank you very much. That's very bright. But here's what I want you to think about. In fact, this is my thinking man. He's thinking it over as we speak. And what I want you to think about is how much risk do you have in your portfolio? First, you got to know what's in your portfolio. And that's what I want you to know. So if you go to noriskinvesting.com, you'll go right to, let me see if I can get you my, no, I don't see it. So somewhere there's a, there we go. This is Nitrogen. Nitrogen is a tool, a partner that we have at Bayrock, and it is the, hold on just a second, I want to change that. There we go. There we go. Nitrogen used to be called Riskalyze. So if you're not familiar with Riskalyze, it's a great tool. Nitrogen, they rebranded, and so that's their name now is Nitrogen. But anyway, that is, if you go to noriskinvesting.com, it will take you to our tool, our partner there at Nitrogen, where you can do a quick survey. And in the process of doing that survey, you will get a risk number. And that risk number will help you. It will help me too if we work together, if we have a consultation, a quick call. I can help you identify how much risk you have in your portfolio very easily. We can do a quick portfolio analysis to see what's in your portfolio, how much risk do you have, and really it boils down to how much risk do you want to have in your portfolio. And another question is how much risk do you need to have in your portfolio? Because if you're a younger investor or even an older investor who needs some returns, you can't avoid taking some risk. We've been talking about the risk of inflation ever since I've been in this business, and it's been a real risk because inflation, while it was at 2%, wasn't nearly as big of a risk as it is today. But it's always been a risk. The value of your money over time going down is a risk. So, 20 years from now, you're not going to have as much buying power in your portfolio as you have today. And with inflation going up, that's even more true than it's ever been. And so managing your investment portfolio is one of those things that I would suggest is an active it's better if you have an active approach with good strategies in place, and that's what I wanted to just kind of highlight and invite you to think about. So, if you're thinking about putting money into a money market account right now with 5% interest, that's not bad. There's another option as well. And you can buy U.S. Treasuries directly from the United States government at U.S. Treasury Direct. But there's other ways to do that. And if you want to have a conversation, give me a call. Hit me up at bayrockfinancial.com. You can, when you go there, let me just show you, move that out of the way and just show you if you jump on bayrockfinancial.com and you click on this little link, it'll take you to my calendar, I believe, if everything's working. Yes, it's working. So that is my Calendly. We use lots of technology here, but it's just a Calendly. It's a calendar, and you can see I have some openings coming up. We are currently, right now, I'm coming to you from the Stephen F. Austin State Park. Hopefully this feed is working well. Leave a comment, let me know. But at any rate, this is this is my calendar, and you can get a click right there. Now, listen, if you're looking for a little help with investments, and I'm speaking and thinking of specific people, and I'm going to send this video to you. I need you to do the risk survey. So when you go to noriskinvesting.com, you'll be able to take that quick 5-minute survey. I need that number. I need to know what your risk number is before I give you any suggestions or recommendations about investing. Anything I talked about today was just an illustration to educate you about what's possible and what some strategies are available. When I talk about TLT and options, those are strategies that you really need to be working with a financial advisor to do that, unless you have a lot of experience managing your investments. So if you're interested in visiting with me, I hope you'll reach out. I'm happy to help, and I hope that you are paying attention to the U.S. Treasury yields, and I hope that you are paying attention to your money. If you need a little help with a financial plan, let me know. I'm happy to help you put together a plan. But we would start with making sure we know how much risk you have in your portfolio, how much risk you want, and how much risk you need to have to succeed. Thanks for watching the video. I will see you next time.